Hello, investors. Welcome to another episode of the DGI Crab. My name is Colby, the DGI Crab, and today I'm going to go over why VYMI is my favorite international dividend ETF. Before we get started, I preface the video by saying that I am not a licensed professional investment advisor. The opinions expressed in this video are just one crab's opinion, and you should always do your own due diligence before picking any individual stock or ETF to invest in. So this was a difficult decision for me a few years ago, trying to find where I wanted to put my money when it came to international stocks. So a little bit about my personal portfolio. I don't own any individual single stock of an international company. Nothing against them. There's some excellent choices out there, but for me, there is enough to keep track of in my portfolio as far as US companies go. So I really don't want to have to keep track of, how do elections in Canada affect the Canadian bank stocks, or how does international relations with China impact Taiwan semiconductors, and just there's just so many things like that I really don't want to have to be concerned with when it comes to international investing. So I've dedicated 5% of my portfolio to VYMI. So I have that exposure to non-US stocks that pay a dividend. So let's talk about VYMI. This one just doesn't get talked about very much on other YouTube channels, so I want to cover it here for you guys. So it was launched in March of 2016. So it hasn't built up a ton of history yet, but it's getting there. It's got just shy of $8 billion in assets under management. The focus is on higher yielding companies. The starting yield is typically above 4%, and it pays quarterly. The expense ratio, a little higher than like your VOOs or your VYMs. It's a 0.22% expense ratio, but I think that that's fairly reasonable for them taking care of international investments that I just don't want to concern myself with, as I said. And they've got 1,500 plus holdings, with less than 2% of those holdings in real estate. So we're getting qualified dividend income, meaning very tax advantaged. We're getting a lot of diversification with those 1,500 plus holdings, and it's dividend focused, getting a nice starting yield of that 4 to 5% most of the time. If we look at the holdings and the dividend breakdown, you'll see that 35% of the holdings are in financials. So you're getting those Canadian bank stocks that make up a nice little chunk of the top 20 or so investments that are there. And then you'll see down there just 1.5% dedicated to real estate at this point. The dividend yield, as of the recording of this video, is about 4.5%. So we like that. 5-year growth rate also at about 4.5%. So those are numbers that I definitely like. 4.5% yield, 4.5% growth rate. That's a nice dividend combo factor of 9%. International holdings, and when it comes to their dividends, just have a tendency to be a bit inconsistent. So you just are not going to see the steady dividend growth rate that you'll see with a lot of American companies and ETFs. But if they can maintain those sort of numbers on a fairly consistent basis, that's good enough for me. If we look at the yield history dating back to 2016, now I wouldn't really include 2016 as a major point of the analysis because they launched in March, so 2017 is that first full year. But you can see that the yield has climbed pretty steadily over the years. The max yield can get up into the 6% range, or at least into the high fives, but usually it's pretty steady in that 4 to 4.5% range. And the growth is pretty stable. So the 2017 that you'll see there, 58% growth. I don't necessarily factor that in completely because that first quarter in 2016 was a very abbreviated quarter. So really I'm starting on 2018, but you get 12%, just shy of 11%. 2020, it took a hit largely due to COVID, bounces back in a big way in 2021. 2022 lost 3%, but then bounced back again in 2023 with an 8.74% growth. So it's fairly steady. It will have some down years, but this one looks like it's going to be pretty stable on a go forward basis. So let's talk about the competitors I considered. There's a bunch of international ETFs. These are some of the big ones from the major players in the ETF space that I looked at. So you have some Vanguard funds. VEA is the largest in terms of assets under management among all of them. VXUS contains every stock that's not U.S. stock, so it's got the most amount of holdings. That's another really popular one. VIGI, so I love VIG for an ETF that holds American stocks. It's focused on dividend growth, so we could look at the international version of that. And then you've got SCHF, which is Schwab's International Dividend Fund, IDV, the BlackRock version, and DWX, the State Street version. So let's just take a quick look at these. VEA has 4,000 plus holdings, very low expense ratio at 0.06%, pays out quarterly. Now, it didn't make the cut due to there's just bigger swings in the dividend growth that we saw with VYMI. And it's just not a dividend focused fund. It's got pretty good numbers. This would be number 2 on my list. It's got a 3.3% yield right now. Nice 5-year dividend growth rate, but again, that's very inconsistent, and it's just close, but not quite. I prefer the higher starting yield and the dividend focus of VYMI. VXUS has 8,600 plus holdings, a 0.08% expense ratio. It pays out quarterly. Now, it didn't make it. Again, it has bigger swings in the dividend growth. It does not have it. It hasn't shown as much share price appreciation, and it also doesn't have that dividend focus. A 3%-ish starting yield, 3%-ish growth rate, just didn't quite make the cut and does not have the share price appreciation to boot. So while I like the overall diversification that it provides, it has just not been as good of a performer. 1,500 plus holdings in VYMI is plenty of diversification for me. VIGI, this one was disappointing. 350-ish holdings, a 0.15% expense ratio, pays out quarterly. Didn't make it due to a low starting yield, a surprising lack of dividend growth, even though that's the point of the silly thing, and it doesn't have the diversification. It's just 350 holdings. That starting yield of 1.5 or 1.85% is kind of similar to its United States counterpart, VIG, but the 5-year growth rate isn't even a full 1% right now. So just absolutely dismal as far as that goes. Let's look at the Schwab version, SCHF. Now, it's got similar here. It's got 1,500-ish holdings, a 0.06 expense ratio. So far, so good there. Now, the SCHF didn't make the cut for me due to a lack of dividend growth. And then it has a semi-annual payment schedule, which for an ETF you're holding long-term, that's not a huge deal, but I just prefer a quarterly schedule as opposed to once every 6 months. It's got a lower starting yield there at 2.7%, and the 5-year growth rate's actually negative on this one right now. So performance just hasn't been there for SCHF in the same way. IDV, our BlackRock version, just 129 holdings with a 0.51% expense ratio. It is a quarterly payer now, but it didn't make the cut due to lack of holdings. It's just not enough diversification there for me at all. It's got a very high expense ratio, and the share price, if you look at the chart, has just deteriorated over the years. So I don't like that as well. It has all the lookings, or all the look of a yield trap. It's got a nice starting yield at 6.5%. It's a high yielder, but the share price appreciation, as I said, has just gone down. And the 5-year growth rate on the dividend is pretty much flat. So that high expense ratio and the share price appreciation, this was just a no thanks from me. And then we've got DWX, our State Street version, 119 holdings, 0.45% expense ratio, pays quarterly, didn't make the cut due to lack of holdings, high expense ratio, depleting share price, and a lack of dividend growth. Just a rough combo factor. 4% starting yield, negative 5-year growth rate. Just not a lot going for DWX as far as I can tell. So I hope you can see here that is why VYMI is my absolute favorite international dividend ETF. There are plenty of other international ETFs out there on the market. Probably don't have anywhere near as many assets under management as the ones that I've gone over here today. If you've got one that you think is better than VYMI and you'd like me to take a look at it, leave it in the comments below and I would be happy to review it. But for now, VYMI sits on top of the pile. It is on the throne for the best international ETF in my estimation. I have, again, 5% of my portfolio goes into this international fund, so I don't have to worry about keeping track of the individual companies. I can get a respectable dividend yield out of it, and it's just a set it and forget it investment for me. I don't really worry very much about it, and I hold it for the diversification primarily, so I'm not just totally invested in U.S. stocks, and it keeps me from feeling like I'm missing out on good solid companies like Taiwan Semiconductors, Nestle, the Canadian banks, etc. So my name is Colby, the DGI Crab. Email me your questions at dgicrab@yahoo.com and check out the links in the description to the video where that will link to each of the 4 tiers. This channel covers 60 individual dividend growth stocks, and the 4 tiers are broken down based on your age for the ones that I think are the best to focus on in your particular age range. Until next time, everyone, take care and keep investing.